Senior Economist at Wells Fargo. She joins us live now from Charlotte, North Carolina. Sarah, thank you so much for being with us. Let's talk about the jobs report that we got on Friday. I mean, it does show somewhat of a cooling beginning, but boy, oh boy, is the labor market resilient in this country, despite what the Fed is doing. Do you think what we saw on Friday in terms of the jobs report represents a turning point in terms of how the Fed reacts going forward?
That's right. So we're still seeing a very strong labor market here in the United States. So 236,000 jobs added over the past month. So that is a step down from the roughly 360,000 pace we saw over the prior 12 months, but that's still well above what we saw over the last cycle average. But I think the direction is important as we think about where monetary policy goes ahead. So we're seeing not just in the jobs numbers that we got on Friday, but really an array of data pointing towards the fact that the labor market is cooling overall, as well as we were looking at some inflation data that suggests that at least over the coming months, we should start to see a more marked slowing that suggests that the Fed is probably near the end of its tightening cycle.
And just in terms of inflation more specifically, I mean, stickier inflation has really been hard to get rid of. We get new data out on Wednesday. What are you expecting inflation-wise?
Right. So we're looking in terms of overall inflation, a little bit of a friendlier print, but a lot of that has to do with the recent drop in gasoline prices that moved through March. So since then, we've seen gas prices move back up. So it's really not indicative of necessarily where the trend is going forward. But if you look at the core consumer price index, so excluding some of those more volatile items like food and energy, what we're expecting there is still another pretty strong print, so 0.4%. And if you're looking at what that means for just the rough run rate of inflation in recent months, still probably somewhere close to 5%. So still well above the Fed's target and still not enough to keep up with wage growth that we're seeing here in the US labor market.
Jerome Powell has talked consistently about hoping for a soft landing in terms of raising interest rates without hurting the economy too much. A soft landing looked possible for quite a while, but given what we're seeing in terms of banking troubles, the turmoil in the banking sector, do you think a soft landing is still possible?
It was never going to be easy. So essentially to pull off that soft landing, you had to get growth to slow just enough below potential, but not so much that it actually turned negative. And that's a pretty difficult thing to do when you only have potential GDP running close to 2%. So there's not a wide margin for error in that dynamic. But to some extent, I think the jobs report suggested that it's maybe not going to be quite as hard of a landing as perhaps previously thought, where you have labor supply coming back that's taking some wage pressures off of the table, or at least lessening them for businesses. And so that's going to help bring inflation down without necessarily having to see outright declines in job growth. But I think just given how high inflation is, how long it's been elevated, so the potential that it becomes entrenched, it's still more likely than not that we will see a recession here in the United States. And our expectation is that probably comes somewhere in the back half of this year.
And given, as you point out, how entrenched inflation is and also just how resilient, I mean, the labor market is, just, you know, the numbers that we're seeing, even though it's slightly lower, the numbers that we saw on Friday prove just how resilient the labor market is. Do you anticipate that, how much do you anticipate, I guess the question is, that the Fed is going to have to continue to raise rates by, and how long for?
Well, the Fed recognizes that when they change monetary policy, it doesn't necessarily show up in the economy right away. And so as they take into consideration how much they've already raised rates, we've already seen 475 basis points of tightening this cycle. I think we're still getting close to the end of that tightening phase of the cycle, to where the Fed gets to a point where they're ready to just sit and see how the medicine takes. So we're still looking for one more 25 basis point hike here in May, but we think that between that May and June meeting, you're going to get two more labor market reports, two more inflation reports. We think we'll start to see enough softening in that data that the Fed is comfortable with where overall policy is, and that they can sit and be patient and let it fully take effect on the broader economy.
Right. Sarah House, live for us there. Thank you so much. All right, still to come here on